Most investors are still asking the wrong question. They're asking how many rate cuts are left, when the next one comes, and where the terminal rate settles. That assumes the Fed is navigating toward a destination. It isn't. It's responding to pressure, economic, market, political, in real time. And when policy loses conviction, risk doesn't disappear. It moves. Right now, financial conditions are easing faster than the Fed can comfortably admit. Asset prices are up. Credit spreads are tight. Markets are acting as if the hard part is over. At the same time, inflation hasn't been eliminated. It's slowed. Fiscal stimulus is still flowing through the system. Consumer cash flow is being supported by timing effects, not organic strength. That creates a contradiction. The Fed wants to support employment without reigniting inflation. It wants to maintain credibility while acknowledging weakness. It wants markets calm without making conditions too loose. Those goals don't coexist cleanly, especially not under political observation. This is where perception becomes reality. Once markets believe political influence matters, whether from Donald Trump or any administration, they stop waiting for confirmation. They front-run the outcome. Cuts get priced in faster, inflation persistence gets discounted sooner, risk assets assume policy support earlier than the data justifies. Not because the Fed promised anything, but because the reaction function is assumed to have changed. That's how credibility erodes quietly. And credibility, not rates, is the Fed's real weapon. Leadership transitions don't fix this, they amplify it. New Fed chairs don't inherit trust, they inherit skepticism. Markets test them immediately, especially when political pressure is perceived to be rising. Historically, that testing phase increases volatility, not stability. So where does the risk go in an environment like this? It doesn't show up neatly in CPI or unemployment data. It shows up in mispricing, in duration risk being underappreciated, in leverage being rewarded longer than fundamentals justify, in volatility being compressed until it suddenly isn't. This is how you get markets that feel stable right up until alignment breaks. That's the real danger here. Not collapse, but misalignment. Assets start pricing a world that policy can't actually deliver. That's why waiting for clarity is a mistake. By the time policy feels clear, repricing has already happened. Liquidity has already shifted. Risk is already concentrated somewhere uncomfortable. This isn't a regime that rewards bold predictions. It rewards resilience. Balance sheets that don't assume smooth rate paths. Assets that don't rely on perfect policy execution. Structures that survive uncertainty instead of denying it. The Fed can still move rates. It can still influence liquidity. But once conviction is diluted by data, politics, or both, it loses something more important than control. It loses time. And markets move fastest when time gets compressed.